Swayam Prabha. Digital India. Educated India.
Hello friends, I am Dr. Aparna Samudra from the Department of Economics, RTM Nagpur University, Nagpur, and I welcome you back to this lecture of growth of fintechs. We have already understood the meaning of fintech. We have also seen that how fintech has evolved over a period of time. In this lecture, we will be understanding that what have been the drivers of this fintech revolution, and then we will also have a look at the various types of fintech. When we talk about fintech, we have seen that how it has evolved in last 150 years, from just being technology for use for transfer of funds to today, where the whole financial system is getting decentralized by way of either blockchain or P2P models or mobile-only banking. What have been the reasons for its fast growth, particularly from 2008, is of real interest to each one of us. So let us have a look at those factors, which are the drivers of this fintech. We can divide the drivers of fintech in three broad heads. One is change in the regulatory framework. Second is the rapidly evolving technology environment. And third is shifting customer expectations. So these are the three broad reasons which have led to this fintech evolution or the growth of fintech. One, change in the regulatory framework. Second is the rapidly evolving technology environment. And third is the shifting of the customer's expectations. Now let us have a look at each one of them in detail. First factor, as we have said, behind the growth of fintech is the change in the regulatory framework. Now this change in the regulatory framework, we say, is further divided in these three subpoints. First, that the change in the regulatory framework happened because the traditional finance is still under pressure. Second, this led to the rise of competition, and also the change in the regulatory framework increased funding for the alternative assets. Now let us have a look at each one of them. As we said, the first is the traditional finance under pressure. When the regulatory framework changed, because of which the traditional finance got under pressure. How it got under pressure? After 2008 financial crisis, stricter regulations were forced on the established banks so that they focus on risk management and compliance. So this put an overload of the regulation on the traditional banks. Because many big banks failed, the regulators said that these traditional banks need to focus more on their risk management, and not only risk management, but also the compliances were made stricter. So this put a pressure of the regulation on the existing banks. Now, because the banks were focusing on risk management and compliances in a greater focused way, innovation therefore took a backseat. Resources were diverted away from developing new products and services to what? To risk management and compliances, and hence it created a vacuum. So, second reason or the second subpoint in the change in the regulatory framework because the banks were now focusing on regulatory compliances, putting a regulatory overload, leading to a vacuum in new financial products and services. On the other hand, this was happening. On the other hand, rise of competition started taking place. Pro-competition regulators like UK's Financial Conduct Authority actively promoted non-traditional competitors. That is, it was the regulators only who started promoting non-traditional businesses into the finance field. Also, regulatory sandboxes were created. That is, new policies allowed fintech startups to test innovations with less regulatory burden. Because, see, why this was all happening was that the financial crisis led to loss of trust. So, traditional banks were under pressure to improve their situation through regulatory frameworks. On the other hand, it was seen that some competition has to come to these traditional financial institutions. So, UK's Financial Conduct Authority, for example, promoted non-traditional competitions. Also, regulatory sandboxes were created. Now, what are sandboxes? They're basically, within less regulatory burden, financial startups, fintech startups were allowed to test their innovations. That is, you innovate, you test with less regulatory burden and then scale. If it comes out well, then scale. So, because of it, what happened was that innovations in the fintech space started taking place. Hence, it opened the door to innovation, which created a more level playing field for the newcomers. Hence, we saw a lot of startups coming in the fintech sector. So, change in the regulatory framework was only bringing competition in the fintech sector by putting regulatory pressures on the traditional banks and giving more impetus to the fintech players or the startups in this field. Another aspect was increased funding for the alternative assets. Post-financial crisis, the low rate of interest were very low. Now, these very low rate of interest led investors to seek higher returns somewhere else, because if in the existing areas I'm getting very low rate of returns, the investors were not highly interested in investing money in the traditional banks or traditional financial institutions. Therefore, venture capital boom took place. Funds flowed into alternative asset classes, including venture capital, because the investors were seeking higher returns. They were not getting, financial innovations were not there. Traditional financial institutions were not giving them good rate of interest. Hence, they were looking for alternative areas in which they could make more money. So, alternative asset classes emerged, for example, venture capital. Now, this fueled the whole ecosystem. The surge in the available capital provided essential funding for a new generation of the fintech entrepreneurs. So, I'm presume that you people are now clear in your mind that how regulatory framework only created a field for the fintechs to grow. The second reason for the rise of fintechs is, one, of course, is the regulatory framework. Within regulatory framework, we saw that how traditional financial institutions were not giving good rate of return. They were busy in complying within the regulatory framework, which created a vacuum of new products, which created less of customer satisfaction, which led investor to seek new investor class. So, it gave rise to fintechs. Second important thing which was happening in the technology environment. The rapid advancements in technology was taking place, which offered new ways from onboarding bank customers to deploying ultra high speed trading strategies. We saw that how electronic, when we go across further, we will see the role of algorithmic trading. What is algo trading? That is how machine learning is used to execute the orders in the stock market. So ultra speed high trading strategies were being designed by technology. Bank customers could now be easily onboarded by using technology. So despite being early adopters of technology, many large financial institutions were constrained due to significant technical debt because they were relying on inflexible mainframe systems that were over 40 years old. So even though we saw that they started adopting computerization, they had ATMs, they had internet banking, mobile debit cards and credit cards, but still they were using legacy softwares. They were using systems, mainframe systems, which were very, very old. So technology on one hand was increasing very fast, which was talking about ultra high speed trading strategies and onboarding customer using technology. On the other hand, the traditional financial institutions were constrained by using old types of technology. This made it very difficult and costly for these traditional financial institutions to adopt modern solutions and keep pace with rapidly evolving market. Therefore, because they were not adopting technology, the fintech startups, they grew very fast. Another reason which led to the growth of the fintechs was shifting of the customers' expectations. Till now, we were talking about the business side, that how regulatory compliances led to growth of fintech, how rapidly technology led to growth of fintech. But something was happening in the demand side also. Something was happening at the customer level also. Now, digital native companies like Uber and Airbnb had set a new digital standard, particularly after 2014. Changing customer expectations, when people could book cab through their apps, when people could rent apartments by number of hours also, shared apartments by way of Airbnb wherever they were traveling. So it changed the customers' expectations. So consumers now expected timely, personalized and on-demand digital experiences from all services. So something which happened from the product side or the services side. For example, Uber was providing very timely cab services to the customers, on-demand service to the customers. Airbnb was providing wherever you want to go for a holiday. They were providing apartments and villas in everyone's budgets as per your needs. So they were providing. So now when people were experiencing such kind of personalized on-demand service, the customers started expecting that this should not be only with respect of non-financial services. Financial services should also become timely, they should become personalized and they should also become on-demand. So they were demanding digital experiences. Compared to these modern offerings, banks' traditional services were slow and outdated. That still people took, it took 2 to 3 days for people to transfer their money from one country to another country or from one bank account to another bank account. So there was customer discontent. This frustration among customers made them more willing to try new fintech solutions. So those startups which were getting fueled by rapidly developing technology through funding from venture capitalists, they were also getting support from the customers because customers wanted on-demand digital experiences which the traditional banks were unable to offer to them. Hence, they started moving from traditional banking to fintech solutions. So this led people to shift from traditional banking to fintech. And of course, another very important event which led people to shift to digital finance was your pandemic which occurred. When everybody was working from home, people started adopting technology for making payments, for receiving payments and doing any kind of business transaction. So after understanding that what were the reasons for the growth of fintech which led the traditional banking to take a backstage, we now move to what are the various types of fintech. So on your screen, we see 6 types of fintechs: neobanks, personal financial management fintechs, fintech lenders, fintech payments, wealth tech, and embedded finance. We will understand all of these one by one. I'm just giving you a brief introduction of these. All these, I have a dedicated lectures on what are each type of fintech models. Now let me start with neobanks. Neobanks are essentially defined as digital-only banks, those banks which have no physical branches. It is not to be confused with banks which have physical branches, but they are providing us digital alternatives also in terms of internet banking. Neobanks are totally different. They are those banks which have no physical branches and they're completely virtual. They're completely digital. Now, these banks offer flexible current accounts, high-yielding savings, debit cards, and money transfer through apps. That is, all the functions which are performed by traditional banks are also offered through these digital-only banks which are called as neobanks. Now, because these banks are virtual, they have no physical branches, their essential backbone is technology, they have lower costs because they do not have any physical branches. They have faster onboarding of the customers because they are using technology. They are taking all electronic documents to process your know your customers. If you want a loan, they have those apps which will take your CIBIL score and decide at what rate of interest you should be given a loan. And they also have a very user-friendly experience. The second type of fintech that we have in the space are the fintech payments, which are the most widely used form of fintech. These are the apps that aggregate financial data, for example, bank accounts, credit cards, expenses of the users. They provide dashboards, budgeting tools, and spending insights into how you are spending, how, where, which money, what have been your transactions. Various dashboards are provided, and then they also give you budgeting tools. That is, you can make your own budgets. They are helping the individuals to make smarter money decisions. For example, we see PhonePe, you see Paytm. They're all those which give you a lot of insights and enable you to make digital payments. The next type of fintech that we have are the investment apps, or which are also called as wealth tech segment, because they are giving you portfolio management services. They are guiding you that how you can make your investments. Now, these are the platforms for trading, that is trading in capital market, whether it is the bond market or it is the equity market. So, they are platforms for trading, for making investments, whether even in not only in financial assets, but also in digital gold. In gold also investment is made through these apps, and they also assist clients to have wealth management. They enable users to buy or sell stocks, mutual funds, and also to get automated advice, which is called as robo-advisors. That is, someone giving me advice as to where I should be investing my money, keeping in mind what investment horizon I have, how much risk-taking capacity I have, and how much funds I have. So, they are advising you on your investment decisions automatically. Now, they have a very important role to play because we say that they are democratizing investing and making wealth management accessible to everyone. Previously, such personalized portfolio management tools were used by high net worth individuals or family offices because it involved someone looking into your finances and advising you personally depending on what money you have and how much you are willing to invest. And generally, those were the clients who had a lot of money to invest. But such professional advice was not given to people who had less sum of money even though they wanted to invest. But when you talk about wealth tech, because they are automated, because they're they're technology based, they are either web based or app based, it helps a small investor also to get a very personalized investment advice. Hence, they are democratizing investment and making wealth management accessible. For example, Zerodha and Grow. These are the apps and online platforms which provide advice to even a small investor also at a very, very low rate, very low cost. So because of this, what has happened is, particularly the millennials and Gen Z, who are generally digital natives, they have started investing in the stock market. Another type of fintech that we have are the fintech lenders. Till now, we have been talking about fintech in the space of making payments, opening bank accounts, or maybe investing. But lending money is also a very important activity which any traditional bank is still performing. Now, fintech are also entering in this field of making lending available digitally to even those people who have no prior borrowing history. So these are the digital platforms that offer quick loans and credit facility. They use artificial intelligence and machine learning and alternative data like digital payment history to assess credit worthiness. Just to give you an example, if there's a young professional who has just started earning, he probably does not own a credit card and he has no asset CIBIL score, but he wants to take a loan. Now, traditional banks may not be willing to give him a loan because he does not have a credit history available to him. But if a fintech is there available, he can use the services of that fintech. Fintech will, using his digital footprints, alternative data as we call it, will assess the credit worthiness of this young professional and then give him a loan. So because they are completely online, because they use digital tools, they have faster approvals and wider reach, which includes underserved customers as well. As we have already seen that fintech is playing a very important role in getting financial inclusion. So fintech lenders is making credit available to the underserved customers as well. Those are the underserved customers which traditional banks generally overlook. They do not want to lend them. So fintech lenders are filling in that gap which is there. Examples of fintech lenders in India, for example, Credit Bee is a startup which is giving fintech lending and also enables fintech investment as well. And then globally it is Sophie, which is a very popular fintech lender. Another very important type of fintech lender and which is creating a lot of buzz is embedded finance. Now, what is embedded finance? Embed means to integrate something. So what are we integrating? It is integration of financial services into non-financial applications and platforms. That is, if there is a non-financial application and I am integrating a financial service into it, then it is called as embedded finance. For example, we have an e-commerce app, let us say Amazon. Now, Amazon is giving you an e-commerce facility. You can buy something, it's a marketplace electronically where you can buy goods. Now, there if Amazon Pay has come, this means it is saying that it's a wallet where you can load your money in and then you can spend on Amazon through it. Or Amazon Pay says that you buy it today, pay later. So what are we doing? We are integrating a financial service into a non-financial application. And that is called as embedded finance. Now, how it is done? This is done through something which is called as API. What is API? API is application programming interface. These are open codes. They get integrate into banking, lending, or insurance, into e-commerce, ride-hailing, etc. So, a non-financial application or a platform, for example, as I said, in e-commerce, the API of a bank gets integrated into it, and then a financial service is provided to you. Because of which it creates a seamless user experience, and it also creates a new revenue stream for that business. For example, buy now, pay later, which we see very frequently these days, that you buy something and they will say, okay, buy now, pay later is there, or EMI financing is there. You want to convert this into EMI, you purchase something, and you are told that if you want to convert this into EMI using credit card, you can convert it into EMI through e-commerce website. So they are all examples of embedded finance. This allows consumers to convert purchases into manageable installments. So what is happening is that new revenue stream for the seller of that good is created, for the provider of that loan is created through an embedded finance. As we said in the lecture, that how the model is of cooperation and competition, wherein technology companies, fintech companies are cooperating with traditional banks, using their banks, customers to provide technology and financial services. So BNPL and EMI financing, examples of embedded finance. So till now, we have understood. Now let me put a small question to you. This is a small case-based question where I am asking you, a ride-hailing app like Ola offers a digital wallet, like Ola Money, that lets riders pay for rides, recharge mobile phones, and even buy insurance. That is, if you download the app of Ola, which is a ride-hailing platform, there is a digital wallet called as Ola Money. If you load money in that Ola Money wallet, the riders, whoever is using the services of Ola cabs, they will be able to pay for their rides. Not only that, they will also be able to recharge their mobiles and even buy insurance. So what is this an example of? Is it embedded finance? Is it wealth tech? Is it payments? Or is it neobanks? What do you think this is an example of? This will be an example of embedded finance. Why? Because a non-financial service provider, that is Ola, is using technology, giving the services of finance. It is not wealth tech, because wealth tech talks about what? It talks about how your investments can be managed. It is not payment. Of course, you are making a payment, but here you are not only making payment for your rights. This is not a financial app. This is a non-financial app. You are also making a payment for using it for other financial products, services purchase also. So it is not payments as well. It is of course not a neobank, because neobank is what? Neobank is only a digital only bank. So this is an example of embedded finance. So let us quickly revise what we have done. We have said that the growth of fintech can be attributed to three prime reasons. Change in the regulatory framework, which happened more so after 2008 subprime crisis. Rapid technological evolution, which put the technology on a faster pace compared to traditional banks who were unable to move at a similar pace. And the changed customer expectations, which were also due to the digital experiences given by, let us say, e-commerce and other on-demand services. Fintech players include existing financial institutions, big technological companies, technological infrastructure support companies and disruptors. And fintech players range from neobanks to embedded finance. So this is the broad landscape of what are various types of fintech players and what have been the reasons for the change in for the growth of fintech. So that's all for now. Thank you very much, learners.